Let's talk about Honasa Consumer. The company reported a good set of numbers for the first quarter, 19% revenue growth led by 25% volume growth as well. Margins too improved by 200 basis points. Ramanpreet Sohi, who is the CFO of the company, now joins in to discuss the quarter gone by, but more importantly, what the near-term concerns are as well. Raman, thank you so much for joining in. The first quarter was good, no two ways about it, 19% revenue growth led by 25% volume growth as well. But, you know, one of the comments in your PowerPoint presentation when it came to the revamp of distribution has the street a little worried. In terms of inventory offsets that you are likely to do for the distribution revamp, what could the potential impact in the near term be as a proportion of your sales?
Yeah, hi, good morning. Thank you for having me. Yes, of course, like you said, of course, we had a good first quarter numbers in, and as part of our annual sort of charter, we've actually set on a project called Project Neve, where we are actually transitioning our distribution from a super stockist-led distributor model to a direct distributor model. And in the process, we've obviously completed some part of transition, but majority of the transition is going to happen in over this quarter and the next quarter. And hence, as we sort of transition and take out a layer of distribution, which is super stockist, we are accelerating the transition, and hence there is a likely impact of about 150 to 200 bips from an annual delivery perspective.
So 150 to 200 bips is the inventory correction that one is likely to see. What does that do to your annual guidance of 20% revenue growth with 150 basis points margin improvement? Do you hold on to that? And is there an upside risk to this inventory correction that you're doing in the market?
See, so let me clarify that aspect. We are very clear that we are accelerating this transition, and we will do this all in a single quarter. And hence, the quarter that we do this in, we will see a one-off exception from a delivery of a top-line perspective and some impact on the bottom line as well. Having said that, for the rest of the quarters in the year, we are likely to go back to our guided strong growth that we've been delivering all through last year and in the first quarter, and also continue our margin uptrend in terms of the scale efficiencies and deliveries that we've been seeing. So, barring one quarter where we're trying to accelerate and be ready and unlock a long-term sustainable, general trade transition potential for us, we will go back to our normal sort of strong growth on the top line, and as well improving bottom line margins as well.
All right. Hi, Ramanpreet. Good morning, and thanks a lot for speaking to us here on CNBC-TV18. This is Nigel on this side. Since you briefly spoke on margins, and margins have improved over the last few quarters, what is the guidance from here on? I recall, it being just 1-2%. It improved to around 7% in the past year. Now you're at, northward of 8%. So for the year, what's the number we should work with? And the key variable when we talk about margins is the ad spends, which are in the mid 30% mark. So for the year, guidance on both these two?
Yeah, absolutely. So, as you've seen in first quarter, we've actually delivered almost 200 bips margin expansion on a year-on-year basis. And, if I sort of exclude the one-time correction driven by our distribution transition, we will move back to our guidance of 150 bips margin expansion on a year-on-year basis. And this will sort of continue not only this year, but next year as well. We feel very confident in terms of how we've seen margin unfold even in Q1, given our growths, and we will continue to work towards improving margin trajectory. And there is fair bit of confidence on 150 bips margin expansion coming in. Of course, like we've sort of said in the past, as the business scales, all our brands as they scale are becoming more efficient. And a part of our margin expansion will come from A&P efficiencies that we see as our brands scale.
So what would A&P settle at? Because I remember FY24, they settled around the 34.5%. The first quarter, you've done around 36%. Competitive intensity is high as well from all quarters. So at what level do A&P spends settle?
See, very difficult to pinpoint exactly at what level, but if you actually look at our guidance of 150 pips expansion on a year-on-year basis, 30 to 40% of that should come through A&P efficiencies.
All right, so 60-70 basis points comes in from A&P efficiencies. I wanted your thoughts on two things. One, offline as a proportion of sales. Now you've reached 2 lakh stores. You are revamping distribution. Last time you joined us, you said about a third of your sales come in from offline. So going forward, what rate is offline channel likely to grow at in the overall growth of 20% that you've guided for? And new products as well. In the first quarter, it's 9%. All of last year, it was close to around 18%. So how much do new products contribute to your revenue going forward? And offline sales as a proportion of your overall revenue comes to what?
See, just to put some perspective to it, currently, of course, Mamaearth, which is the largest brand, offline channel is driven by Mamaearth specifically. Our younger brands, our second brand, which reached a 500 crore annual run rate in the previous quarter, in Q4 of last year, continues to do well, and we now slowly moving that brand also in key offline accounts as well. It started with modern trade and then some key beauty counters as well. It's going to be a gradual progression as we move younger brands into offline. But typically, Mamaearth is going to lead the offline charge for us, at least in the near term to medium term. Having said that, given all our younger brands are online first brands, digital first brands, the mix of offline online is likely to be in the same ratio for the near term and the medium term. And of course, as the younger brands move offline, we'll then see offline contribution to the overall business also move up over time.
Okay, all right, Ramanpreet, final question before we let you go. You have given us targets for Dermaco, 500 crores for Aqualogica, as well as Dr. Seth's, and 250 crores for BBlunt. By when do you hit all these targets?
We continue to be very positive on how these brands are being loved by our consumers. In fact, BBlunt actually reached 100 crore in annual run rate, which we've scaled almost 4x since we've acquired within 2 years. So we're very confident on how these brands are being loved by consumers, how they are doing on our online platforms. And as we take them offline subsequently, we'll see that some of these numbers that we guided over the next 2 to 3 years, we should be able to hit these run rates.
Quickly, if you could tell us, where are they right now? BBlunt, you said, is at 100 crores. Where is Dermaco, where's the Dermaco, where is Aqualogica? Where do those brands stand right now in terms of ARR?
See, we normally announce the brand milestones as they hit new milestones. Having said that, we continue to see them scale up. The last announced milestones for each of these brands were 500 crores for the Dermaco. BBlunt, we just announced this quarter 100 crore annual run rate, and Dr. Sheth's and Aqualogica are between 180 to 200 crore run rates.
All right, we look forward to them hitting the milestones that you spoke about, but more importantly, breaking even as well and contributing to the EBITDA as you're guiding for 150 basis points improvement. So the next couple of quarters maybe blip because of that inventory correction to the tune of about 100-150 basis points, but thereafter 20% sales with 150 basis points margins is what you have guided for. We'll hold you on to those numbers. Thank you, Ramanpreet, for joining in and giving us those details. With that, let's shift